Northrop Grumman's Q2 2026 report is out. And for you, the retail investor, here are the headline numbers you need to know right out of the gate. Sales hit $10.9 billion.
Which is a pretty massive number to absorb.
It really is. That's a 10% sequential jump and a 5% increase year over year. Diluted EPS came in at $7.68.
Right, and management immediately rewarded investors by raising their full-year guidance.
Yeah, sales guidance is up $250 million to a new range of $43.75 billion to $44.25 billion.
And the profitability metrics followed suit. The MTM adjusted EPS guidance was raised by a full $1.20,
setting a new range of $28.60 to $29.10. So our goal today is to move past these headline numbers and really unpack the segment performance, the margin shifts, and, management's commentary.
Because there are some very notable risks inside this earnings report that people might miss.
Exactly. We want to make sure you know exactly what is actually driving the stock.
Right. You can't just look at a revenue beat and call it a day.
No, absolutely not. But before we break down the individual segments, we really need to address this massive demand signal and clarify a slight distortion in the year-over-year EPS comparison.
Yeah, because on the surface, the EPS story looks a little contradictory.
It does. Let me play devil's advocate for a second here. Q2 2026 EPS was $7.68, which is actually down from the $8.15 they posted in Q2 of 2025. So, if you're just glancing at the sheet, a shrinking EPS while revenue grows, is this drop a red flag for the core business?
I get why people ask that, but I can calmly debunk this right now. It is not a red flag.
Oh, really?
Yeah, you have to strip out the one-time events. Back in Q2 2025, Northrop recorded a massive $231 million gain.
Oh, wait, that was from divesting their training services business, right?
Exactly. They sold off an asset, and that single divestiture added about $1.04 to their earnings per share a year ago.
So it artificially inflated the previous year's comparison.
Precisely. So when you adjust for that divestiture, the core operational EPS is actually growing.
Okay, that makes a lot more sense.
Yeah, and honestly, the true headline for future revenue isn't even the EPS. It's their net awards. They pulled in $20 billion in net awards just this quarter.
Wow. $20 billion in 3 months.
Right, and that pushes the total company backlog to a record $105 billion.
$105 billion. So what does this all mean?
Well, it means the demand signal is deafening. The government wants what they are building.
Right, so demand is clearly not the issue. The focus for investors must be entirely on execution.
Spot on. It's all about how efficiently they can clear that backlog.
Which naturally shifts our conversation to the specific segments. With a $105 billion backlog, we have to look at who is successfully converting that demand into top line and margin growth right now.
Because it's definitely not perfectly even across the board.
No, not. Let's run through the winners first. Aeronautics Systems sales jumped 13% to $3.5 billion.
That is a lot of volume.
It is, and it's driven heavily by the B-21 program, the E-130J TACAMO ramp-up, and, a higher volume on the F-35 and E-2.
Yeah, aeronautics is definitely pushing metal out the door.
Right, and the mission system saw a 3% sales bump to $3.25 billion.
What's fascinating here is the margin story on mission systems.
Okay, tell me about that.
Well, while their revenue growth was relatively modest at just 3%, their operating margin rate actually expanded. It went from 14.0% up to 15.4%.
Wait, really? 140 basis point jump.
Exactly. And that is incredibly hard to do on mature fixed contracts. It was primarily due to higher net EAC adjustments driven by improved performance.
So they're just operating more efficiently.
Yes. And this is exactly what retail investors want to see. You want a segment squeezing more profit out of the contracts they already have on the books.
Right. That's the dream scenario. But execution isn't flawless everywhere, is it? We have to contrast those high flyers with the segments where margins actually contracted.
Yeah, the segments that drag the overall company operating margin down to 10.1%.
Exactly. I like to think of managing a $105 billion backlog like running a massive industrial pipeline.
Okay, I like that analogy.
The demand is pushing incredible volume through the pipes, but investors really need to pay attention to the margin leaks.
The leaks that are currently springing up in the defense and space pipes?
You read my mind. So let's look at defense systems. Sales actually grew 5%, right? Driven by Sentinel and IBCS.
Yep, top line looks healthy.
But the operating margin plummeted from 12.7% down to just 7.5%. That is a massive leak.
It's a huge hit. And the cause is very specific. They took a $68 million unfavorable EAC adjustment on the stand-in attack weapon.
The SIAW program.
Exactly. It was due to higher costs to mature the production of that weapon, which unfortunately offset the favorable adjustments they had on the Sentinel program.
So it just wiped out their other operational wins.
Basically, yeah. And Space Systems saw a very similar squeeze.
Right, I saw that. Sales were up 4% there, but their margins dropped from 10.6% to 8.6%.
And the culprit is exactly what you'd expect, another unfavorable EAC.
Let me guess, a massive one.
A $91 million unfavorable EAC on the GM63XL program.
Wow, 91 million.
Yeah, purely due to increases in the projected cost to complete the program. It's just costing them more than they modeled.
So knowing these specific cost pressures exist in defense and space, how is management positioning the company's capital to actually handle this record backlog?
Well, CEO Kathy Warden addressed this directly in her commentary. She emphasized remaining focus on delivering with, quote, speed and precision.
Right, but words only go so far. What are they actually doing?
They are aggressively investing in capacity. They aren't just sitting back.
Yeah, I noticed that capital expenditures are projected to stay elevated at around 4.5% of sales.
Through both 2027 and 2028.
That is a ton of money being poured into physical infrastructure.
It is. They are building out the physical footprint required to handle the volume.
Here's where it gets really interesting, though. There is a specific operational detail buried in the report. Northrop currently has 10 new multi-year agreements in the works.
10 of them?
Yeah, as a supplier for tactical weapons.
Oh, wow.
Which proves that those CapEx investments are directly tied to securing long-term capacity for this specific demand surge.
Yeah.
They are locking in the capacity right now.
It's a very proactive strategy, but, those multi-year capacity investments rely heavily on steady external conditions.
Which leads us directly into the notable risks management flagged in the report.
Right, because you can build the best factories in the world, but macro factors can still wreck your margins.
Exactly. And the most obvious macro risk is their sheer dependence on the U.S. government.
Yeah, specifically the threat of continuing resolutions.
Or government shutdowns. I mean, if appropriations get delayed, that massive backlog just sits there. The cash stops flowing.
It's a huge bottleneck risk. And then you have all the ongoing macroeconomic pressures.
Like the labor shortages and the supply chain challenges.
Exactly. And if we connect this to the bigger picture, I really want the listener to understand that these aren't just boilerplate theoretical risks.
No, not at all.
We literally just saw the inflationary pressures and supply chain challenges manifest in real time.
You're talking about those unfavorable EAC cost growth adjustments in defense and space.
Spot on. The $68 million on the SIAW and the $91 million on the GM program.
Right.
The risks are already actively applying pressure to their margins today. It's not a future hypothetical.
Which leaves you with a final analytical question to chew on today. If the defense backlog is sitting at a record $105 billion, but margins are actively being squeezed by the rising cost to complete these projects?
Is the future of defense investing less about which company wins the contract?
Right, and more about which company can most accurately forecast inflation and labor costs over a 10-year horizon. It's definitely something to think about as you review your portfolio.
Absolutely. The backlog is great, but execution is everything.
Exactly. Well, that wraps up our deep dive into Northrop Grumman's Q2 report. Make sure you hit follow on the show so you don't miss our daily earnings coverage. See you next time.